Hey everybody, it's Booksy here. Really quick, thanks for everybody who liked and disliked the last video. If you liked it, I do appreciate the um, sincere thoughts that you posted, and I hope that becomes a tool for everybody to use. I recognize there's some people who may not like this or maybe didn't like the way I explained it, and thank you as well, for the dislikes, for keeping me humble. I appreciate it. I know that I'm just a guy who figured something out, but there's a lot of other people who have really good information. And my hope is that when we start overlapping these things like a web, that, sort of like at a doctor's office if you ever got an eye exam, you know how they kind of keep flipping the little lenses to kind of improve until they get to the right spot where you can see it clearly. I really think that's what this is. I think that this discovery of the fractal pattern. And if you didn't see the video, basically this is kind of what I figured out. Now this looks like a mess. I can't go through this all over again. You'd probably be better off just watching that video. I know it's like 30 minutes, but I tried my best to explain it in detail so that it was clear why this is the fractal pattern and why it has repeated. And basically, it sort of, in my opinion, starts on the blue, ends on the blue, right? So it goes from like blue triangle to blue triangle. That being said, patterns are amorphous. They don't have to, you shouldn't really consider them as like having starting and stopping points. It's kind of like really every one of these points, like from R1 to R1, that could be considered a start and stop, so on and so forth. The reason I think it may be the triangles is just because I can see back here perhaps that we had perhaps, and I'm not 100% sure about this, but that this could have been the beginning of it. I haven't gone back further. I know there's other people who say it's sooner than that. It might be, this right here could be an R1, and then, R1 into R2, right? And then we kind of might see the same kind of thing here with a T4 and whatnot up here after a little dip. I'm not going to keep going backwards in time forever and ever because ultimately, like, I don't feel like it's super helpful because back here was before the buy button was turned off and before we really got into this kind of battle with hedge funds and other institutions who might be heavily shorted, have heavily short positions in AMC, and are trying to get out of this position. Um, so that being said, this video is more about application and what I think how we could sort of interpret this and use it. If you don't see the value in knowing the patterns as they play out beforehand, I don't know how to convince you like that's valuable. I mean, I personally think that's super valuable. If you knew like right here that this is the pattern that was going to play out, then imagine your decisions on where you might make buys as you're trading this. And I'm not saying like, hey, if you're a swing trader, you can't buy and sell AMC. Obviously, that has happened. That's why we've had ups and downs. And a lot of it might be institutions shorting down, right? And then maybe they short and they cover, short and cover. And they're probably doing this for sure to help drive this algorithm, these microtransactions, right? I think everybody agrees that's going on. But for a day trader who's trading this, obviously that would be super valuable. But for somebody who's maybe in the ape community who is holding this, who's not selling it, how would that be valuable? Well, knowing that this is what they want and this is how they're going to get there is super valuable to me. It takes a lot of stress off. It makes me understand the price action better. I don't get emotional about it. And in addition to that, if I'm going to accumulate, right, if I'm going to make buys, I now have very strategic places, maybe on these lower points, that I know like this is probably how it's going to happen. And that after we do our R1, when we start seeing it turn around, as all these indicators are showing, yeah, okay, the volume's disappearing. We know it's going to form a base, go to R2, form a second base, right? And that happens here, right? It happens here. It happens everywhere. And so these are opportunities to make smarter decisions. And To me, like I can't understand. There's some people that were on Twitter who were saying, and call me smooth-brained, if you will, but there were some people on Twitter who were saying that this doesn't make sense to them. Like, why does this matter? So what? I think that step one, or the first reason it matters, is because it's a making you smarter, giving you the ability to see what's going on behind the scenes. Why this looks like the way that it looks, or at least a big part of that puzzle, right? And then step two, it gives you the opportunity to make smarter decisions about your investments. Now, I'm not a financial advisor, and everybody should know that. No YouTuber typically is, if they're on here just kind of spouting stuff off about AMC. Most of them are not financial advisors. I don't think I've seen any that are. And the reason that people say that is they don't want to take responsibility if you screw up a trade. And I agree, like, that's not up to a person on YouTube to decide. It's your pocketbook, it's your decision. And everybody has to decide what's right for them. That goes without saying. But just on the whole, anybody who looks at a stock and could kind of estimate where the tops and bottoms are, I mean, you want to buy on the bottom and you don't want to be buying up top, right? That doesn't mean that we should never buy up top. There are opportunities, right? And I'll get into that in a minute, where buying may actually be a good thing if your goal is to squeeze, okay? And so I'm going to talk a little bit about what I think is going on based on my conversation with Astro yesterday, and how I think that, for lack of a better word, a squeeze could be manufactured, okay? And I'm not talking about everybody deciding to do all the same thing at the same time. I'm talking about what goes into a squeeze and why knowing this algorithm and knowing the trading pattern is super helpful to understanding that. So really quick, this is basically the overview. Okay, I'll do one and done overview here. You essentially have, it starts with a wedge, right, that's formed after the head and shoulders that typically, not always, but typically it drops down. And then we do these kind of retests, 1, 2, 3. We're testing right here a new sort of plateau. And one of the reasons that you kind of see this thing like go up and drop, go up and drop, go up, drop, go up, maybe even drop here a little bit, I think it will, is because of this. Because this part right here, this is a retest of this upper line. Like if I were to move this up here, okay, this is a retest of this right here. Right, this previous support, which always goes back to the previous test, bottoms. Okay, see that? So that being said, we know that it kind of rattles around. We get the third test, we break out. This R1 then becomes kind of significant. It's a liquidity test. And this is typically where you're going to see high amounts of volume. See that? You also see high amounts of volume on some of these other places, like on the beginning of the head and shoulders, sometimes on the wedges, sometimes, again, on the R1s, we typically see always a spike. This is around one of the wedges right here, and at I think a reverse head and shoulders pattern. Now, this one's kind of unique because it basically, these volume spikes happen at technical breakouts, right? And so the technical breakouts then become very significant. And I'm kind of bitter about this at this point, and I'm just going to say it, but there have been a lot of people who say technicals don't matter. This thing is so manipulated, technicals don't matter. But let me assure you, technicals do matter, and this is why. Because it's these technical breakouts that brought in the volume. And they coincide with these specific markers, okay, these specific points where we see certain patterns happen. And I will tell you right now that there has never been a massive amount of, now there's been like liquidity, you can see these runs here bring in a lot of volume. You can see these runs up here typically bring in some volume. But I'm going to tell you right now that the section from R2 to R4, okay, this section right here, the only purpose of this section is to kind of reach the height that it wants to reach at this point. Okay, the liquidity test is over. It's already happened at R2. R1. The liquidity test is done. The purpose of the section from R1 to B4 is to bring us back to the previous level. Okay, right here down to B4, bring us back to the previous level. Do you see that? This is it. This is what they're trying to do. They're trying to basically create a beta neutral situation because they want volatility to decrease and they want the short interest to drop, right? Because days to cover is going to be dropping. If days to cover goes up, what we see are big issues for them, right? Because this is what's happened in the past. And I'm going to get to that in a little bit. But basically the goal after R1 is always to kind of get back down to a new sort of base and try to establish into the bottom. So that being said, look at what happened back here. R1 was the liquidity test, and everybody thought that was a fluke. So if that's the case, everybody thought that was a fluke, we were kind of all wrong. This was just a random liquidity test. Well, it seemed random at the time. Now we know, hey, this wasn't random at all. This was predestined, if you will. Like, this is where the algorithm wanted to do it. It was going to do it. But we all were looking at this like it mimicked May, and it didn't. This was actually a liquidity test. It was part of the algorithmic trading pattern. And then from there on, the goal was never to run up. Now, you see a volume ramp here, but it doesn't reach the highs that this reached. All right. The goal here was then to get back down to what? The T3 level, okay, or close to it. Now, we got a little higher, but not by much. If I were to kind of continue drawing this, it actually looks like it basically went right to it. So I don't even think we got much higher at all. So did the algorithm do what it wanted to do? Yes. And this is why knowing this is super important and why technicals matter. Because what happened back here is based on a couple different things. It's based on technical breakouts, liquidity, all right, didn't pass the test here. It actually went back down, all right, and it was going to try to find a new base. And then something happened. We got a volume ramp, okay, and we had technical breakouts. And the technical breakouts happened at these really specific points, which I'll talk about, and they caused the squeeze. And I'm talking about the second squeeze. The first squeeze, I think it's the same deal, right? Technical breakouts caused the action, but there were also some other things going on behind the scenes. So that being said, it is no longer, I do not believe it is any longer acceptable. I don't think it's ever been acceptable, by the way, in AMC, but especially now. I am 100% against, and you can have a different opinion, like that's fine. It could be your opinion. You could say, no, it doesn't matter. But I'm telling you, like right now, when this thing goes, it's going to go on a technical breakout. 100% guarantee. It's going to be one of these markers, and it's going to specifically, more than likely, be either a wedge breakout or an R1. Because wedge breakouts both kickstart and propel. All right, so here's a wedge breakout, here's a wedge breakout. They kickstart these runs. The R1 indicator right here is basically what I call the first big run, all right, because it's the liquidity test. That also played a big part. And in this case, we had this reverse head and shoulders, but we haven't seen anything quite like that just yet. And it's possible, you know, that we get a reverse head and shoulders over here. I said that in the other video, but I'm not sure. So what am I talking about with these like key dates? What else would need to happen? Okay, so keep in mind that these are the liquidity tests. We kind of can see them pretty clearly. All right. This right here, these are our liquidity tests, and these happen on technical breakouts, okay? But these are R1 spots or spots where we have some kind of a technical breakout. So right here was an R1. This was a, more of a, I'm sorry, let's put this back on for just a second. This was more of a technical on the head and shoulders. It didn't really play out, by the way. But I'm looking at volume spikes that are kind of happening sort of in these middle sections. where maybe everybody was thinking that we were about to have another run, or it was possible, right, that we were going to rebound. Like here, everybody was like, "Look at that George W," and it wasn't a George W at all. It was a trap, okay, because they were going to drive this thing down further and make everybody get really discouraged. All right. You have This is why people think technicals don't work, because when you're looking at it, you're not looking at the right technicals. Now we have the map. Now we can look at the right technicals, and we can see how they might work. So basically, these are key spots. And what I'm looking at right now, and I'll kind of jump around a little bit, but we're going to come to sort of a conclusion very quickly. Basically, you've got these like blue markers, and you can see that these blue markers often line up with these liquidity tests. They don't have to. I'm kind of missing one right here. It went missing. There should be one right here. I think it's like there or something. It's kind of in between these two. I must have deleted it. I apologize. But these liquidity marker are these liquidity runs, right? These things that kind of are like high volume spikes, whether it's an R1 or it's a technical breakout like down here. These always occur around these markers. What are these markers? Well, thanks to Astro, I know now that there is a short interest publication that occurs. And when we see this short interest publication, we see that typically, not always, but typically if it coincides with a possible technical breakout, we might see a run. Now, depending on where we are in the algorithm, sometimes you see a drop shortly after. It actually happens quite a bit. And I think it's because days to cover has gone down. All right. Short interest has gone down basically. And we're looking at less pressure to get out of your short positions. So if you have a lot of pressure to get out of your short position and you see that the short interest has gone up and days to cover has gone up, this is like a risk tolerance thing. You're going to more than likely exit positions. So on these markers specifically, what occurs right after both of these is essentially the squeeze. All right. Same thing over here, although it happened, kind of in the middle. Probably there was another one right here, right before this run. So these two areas now look very similar when you know that this is when those publication dates happened. And this is what they're afraid of. They don't want to be caught in a situation where short interest has gone up, right? They're going to have to cover because days to cover goes up, all right? And it's just going to keep going up as these what Asher called noise really is just volatility, all right, between these different markers, between these different reporting places. So what's the goal then? Well, the goal then is to target and be as flat as possible. So now I'm going to show you. So what I did is I hit on every one of these intersections. I hit where did the stock pass this place, okay? Where did it pass when these publication dates were happening? And I'm going to get rid of some of the stuff so we can just see a little clearer. So let's look at this area really quick. Where did it pass through? So if we were to look, here it's actually very low. But interestingly, but from one to the next, look where they had to go. What did they try to do? They tried to level it out. They tried to knock it back down, right, and level it out. And then from there on, check out how level this is. Now, all of us kind of know this intrinsically when we're looking at stocks, that when you have a wedge pattern, right, you're trying to sort of consolidate, all right? And a lot of people, when I was learning stocks, I was just kind of like, oh, it's because of indicators, it's because it's overbought and it's oversold, and that's why it's kind of bouncing between these regions. And that's true to some extent. But this right here, these crossing markers are where those reports happened. And that is not a coincidence, right? That they just happen to be, these reports just happen to be right on the money here. But what happened here, right? So it got out of hand. And from here to here, look at that. Look at the divergence, all right? Probably, I guess it was over here, same deal, right? So you have this kind of a, I always forget where this tool is. Where are you, tool? There we go. Maybe it was like over here or something, okay? You have this kind of desire to sort of keep it flat, but what happens when it doesn't? All right, what happens when it doesn't stay flat? Now, I know what it looks like. It looks like I'm kind of just drawing like the pattern of the stock. But look at this. When it was going down, all right, nobody cared. But then when that short interest publication came out, and then we had this massively volatile section between one to the next, all right, and we're talking about, man, I really wish I had that date up for this one. I feel like it's probably right around here. They're almost equally separated. Some of them are slightly off, but they typically are every couple weeks, every 2 weeks, I believe. So yeah, so like when it shifted drastically from the pattern that they wanted, what did they do? They tried to flatline it as much as possible. So now, knowing that, and knowing that they're using that fractal pattern, okay, they're using the fractal pattern to try to flatline it, then suddenly it becomes a lot less about, you know, oh, when are we going to get, the volume? When are we going to do this or that? It's more about trying to create, again, this kind of beta neutral where we're trying to flatline the stock as much as possible. And you can see that obviously with a tightening wedge, we are kind of accomplishing that. Now, if I'm being, as hedge-like as I can, all right, I kind of think that this down here, not up here, but this down here is more or less kind of where they want it. All right, more or less. And that's kind of obvious. It's like almost the dead center. But they want it to be lower, right? They want the option to cover lower. I brought up this chart because this is a accumulation distribution line, and I want you to see what's going on here, okay? So back in, I know this looks completely different, but the goal here was the same, all right? The goal here is the same. Look at where it is by the time it's flat here, all right? But then look at where the indicator is. And accumulation's still ramping up into this section. They don't want that. They don't want this to continue up because then they can't maintain this sort of flatness. So they're using, buying and selling to obviously like level this thing out. But then when there's a break of that line, all right, hard to the upside, things go a little haywire. And it's the same thing over here. It's just a little bit more reversed, right? So let's say they're doing it like kind of like this. So as it's approaching sort of the target range here, like where they want to be as low as they can, right, on these reporting dates, we can kind of estimate like where the next moves might go. Where do they want it to go? Do they want it to go up here? No, they do not. And I know that, again, this is kind of obvious stuff, but without even looking at this. But if you know, so now think about this. If you know the fractal pattern is going to go from here to here, and it's going to look just like this, and you're really just trying to get from, A to B every time. You're trying to baseline right here, trying to baseline right here, right? From here to here, okay? From here to here. Things are getting a little wonky, right? It's a good thing for us. My point is this. Knowing that you know that the fractal pattern looks like this, now do you think you could possibly predict what they want to have happen right here and what that price action might look like? If you know that they're trying to kind of keep it within a certain range, okay, and they're trying to keep it as close as possible. See how we're deviating less from that line, even on these highs? We're deviating a lot less from kind of where they want it to be at these specific dates, all right? This could still end up being above here. But if it were to, this is kind of what we're getting at here, if it were to deviate again and go off the line, deviate and go off the line, that's how you get a short squeeze. Now, why is that important? Because for a long time, I kept thinking that all we needed was a technical breakout, and I do still think that. And there are a lot of institutions that are on our side that also think the same way. But that's, it's entirely possible. I'm not saying it's I'm not saying this is going to happen, but it's entirely possible now. My belief is that it's entirely possible that if we don't get the deviation that causes volatility and short interest to rise and days to cover to rise, that this really does kind of flat line. Now, does that mean it will go down? Possibly. I think it means that if an institution is looking at this and they see it kind of flatlining and they don't see retail coming in and they don't see other institutions coming in, do you think they'll sell? And that's the question. We don't know. Because a sell from an institution could cause a sell-off. Now, does that mean that we won't see a short squeeze if they start selling off? No, because if they sell off, right, maybe it gets down to like $14 again, that'd be crazy. But I had targeted maybe 13 area just based on speed lines. Do you think that they would cover at 13? Perhaps, because the buying pressure might be so high at those levels that it starts moving up really quickly again, and they just want to get out while it's low. So even a sell-off at this point would possibly still like really screw them over, basically, to put it really simply. So they're in a really bad situation, I think. They're trying to buy time, and they're trying to hope that people just kind of get bored with it and move on. And to be very honest, I think a lot of people are getting bored. I don't think they're necessarily moving on, but a lot of people are getting bored. They're looking at it and they're saying it's not moving. People keep moving the dates out, and for good reason, because we see these things happen and we don't see on these liquidity tests, these markers, we don't see a breakout that's technical that causes a lot of FOMO and brings in the volatility, right, that we want, and then boom, right? We don't get the deviance, or we don't get the deviancy, that deviates from this kind of pattern where we're building around. So all that being said, to manufacture a short squeeze, quote unquote, you do need technical breakouts. You need volume, you need volatility, and you need short interest and days to cover to rise. And again, I think everybody who's in this community kind of knows this, but now that we have this kind of roadmap, one of the questions that I was thinking about yesterday was, how do we navigate it, right? Like what would be, like, if we don't know how long each of these takes, then what's the benefit of knowing? And that is a real question. But now I kind of feel like I understand better that the goal here is to try it to wear people out, right? But also to try as best you can to sort of maintain, all right, when you cross these blue lines, these are the publication days, to maintain low volatility, to maintain short interest and all that other stuff, all right? To kind of keep that as a baseline. So the goal here then, and they are making money, by the way, off of people when they're doing this. They're hedging, all right, down and up, down and up, down and up. They're canceling it all out, but they're using that to make money, right, up and down. So now the goal then would be to try to pass through these points. So coming to like the conclusion here, what do I think the hedge funds want? I think, and I'm just saying this just to say it, I think they don't care really that much what happens from here to here, as long as they get their liquidity test over with, okay? As long as they get their liquidity test over with, and they try as best they can to come back to center. So that could mean that right here, we see like a big fallout. I don't think that's going to happen because of that T1, T2, T3 test that tests this right here, typically. But it does mean that if we don't pass, this is the R1 liquidity test, all right? Now, if this happens at this speed, we could be on an R1 liquidity test right here at November 24th, which is huge. This is the R1. The R1 could be what propels us up and over and get the technical breakout, which would bring in possibly a lot of volume and more volatility. They don't want that. What they want is they want the R1 liquidity test to fail, all right? And then probably what they want is it to bring us back down, all right, and establish a new baseline that has a lower slant. So right now our slants have gone up. This is what happened on the last one. In the last cycle, it went up. They want it to go back down because they want it to sort of start moving back towards the baseline. Again, kind of wearing people out. So they'll use things like head and shoulder patterns to get there. They'll use things that look like technical breakouts to get there. Any one of these things could potentially be a catalyst, right, to break out. So this is a technical breakout spot right here. This is a technical breakout spot right here. The goal is always to get it back to baseline. So if we broke out technically here, it could bring in enough volatility, right, that they don't meet their baseline. But even that, look at this, even that's not really that far off from what they want, right? So this could be just a big scheme, and then people get discouraged, maybe they sell, and we end up going back down for a bit, right, back up, and this could go on and on and on. And this is why people really dislike the stock market, because it's so manipulated, it's nonsensical, okay? It's not moving the natural direction it wants to move with the amount of buying pressure that's happened from the large majority of stockholders, which are retail. So then the question is, well, if this is what they want to kind of keep it down, maybe to give people hope and then rip it away, well, how do we take advantage of what we know are these liquidity tests that are occurring typically at or around these markers, all right? How do we take advantage and understand when is the time? And again, I'm not a financial advisor. I can't tell you when to buy, but you got to make your own decisions. But when would be the best time to take advantage? It would be on technical breakouts. So one technical breakout could be that T1, T2, T3, breaking that trend line, going into a R1 that breaks us out, right? And a retest that could be confirmed only if volume comes in. I'm calling this one the Christmas turkey because it would put us right around Christmas time on the major run. Now, this doesn't have to happen this way. It doesn't have to go up like that. It could go flat for a while, right? Sideways and up. I'm just giving options. What I see, this tests maybe 72, come back down. Everybody's like, oh no. And then it does this thing where it goes up, breaks down. Everybody's like, oh no. And then it does run again because this is what the algorithm does. There's one option. This one I'm calling walk hard. Even this is better than nothing because this could be a big deal, right? If we're deviating again, I don't think it's enough of a deviation. It's still lower than this previous spot, okay? But this could be an option, is that we put enough pressure on, not just us as retail, but also institutions, put enough pressure on it that we start kind of moving up and we get away from what they've considered a baseline, where they're trying to kind of keep it at each of these markers. If we start trending up on this thing, we're putting more and more pressure on them, right, to cover. This is what I'm calling the melt. This is my least likely, but there could be a technical breakout here because we are about to form a little wedge, the blue wedge. All right, I don't have it visible right now, but the blue wedge is right here. This is possible. We did do this on previous runs, okay? This would make us bounce at like close to 72, come back down to like 50, 55 or 52. Those have been pretty common ranges for us in terms of accumulation and distribution, but mostly distribution lately. And so this is totally possible, but it would require a massive spike in volume and volatility. An institution could step in, or somebody who's got a lot of money could step in and do that. Retail can't do it because we can't buy all at once, right? And that's kind of the big problem of the markets now, in my opinion, is that it's okay for an institution to buy, a million billion shares or whatever, but retail, you can't coordinate, so, or collude. Um, but yeah, that's the melt. Here's this one I'm calling the shake and bake. This would be one that would be very like, call it the shake and bake because it's meant to like throw you off, right? So we kind of consolidate, we rip down pretty far and we do the test. This happened before over here. So it's totally possible where we just kind of drop really far and hard all of a sudden, and it kind of spooks people. Could even come down and test like really violently. I don't think they want that though, because they don't want to increase volatility. Could come down and test that pretty violently. But it has to test this baseline, right? It does it every time. So it would come back up. And then the R1 and R2 and R3 would look pretty weak, okay? But maybe we gap up, we get that, or gap down, doesn't really matter. This could end up happening like down here, okay? Gap up or gap down causes a spike in volatility, and the head and shoulders propels us upward because that would be a break upward, right? It had to be inverse, right? And then we go from there. I'm calling that the shake and bake because I think that's made maybe a little bit of a difficult path. The sky is falling. This is my last one I'll present, and this is all I'm going to say today about this because I'm going to watch and see what happens here and see kind of where we are. But this right here is this would be like the sky is falling, right? This is kind of what I meant earlier. Like you have this sort of R1, R2 that's kind of weak, and then we move into the wedge and it breaks down instead of breaking up. And think about this. If it breaks down here, that's actually possibly a good thing. Because if it breaks down here, like it just gets really tight and everybody's like really excited, we might break out and then it just breaks down. Everybody would panic and be like, great, another week of nonsense. But really, if it breaks down, this could be a reverse head and shoulders because we know that comes next. And reverse head and shoulders propelled us up on that run to 72. So down here, I would expect high amounts of pressure in buying. And now if it didn't, and we kind of just like flatline down here, we're talking about something else entirely, right? But certainly it's possible it wouldn't go down that far. It didn't stretch right, but you know what I mean? Like we do this kind of reverse head and shoulders that's really weak, and we come up here, and we get the wedge again, and then it kind of comes down. I don't see that happening because some of these indicators have always lined up. Like wedge to wedge, they almost always line up. And so you create a new baseline, right, for your tests. There are times when it's gotten so crazy that it just doesn't work anymore. And that's kind of what we want if you're looking for a squeeze, right? But basically it'd be like that or something. And maybe the wedge would kind of touch it. Okay. But the point is that this is a possibility too. They try to spook everybody, and then maybe some of your bullish institutions step in and really take the reins and go. Now, it doesn't have to happen in this time frame. We don't know for sure yet how fast we're going because remember, each of these has been different. We went medium, large, small in terms of these fractals repeating. But if the goal of the fractal, remember, if the goal of the fractal is to get us basically to this baseline every time and stay within this sort of standard deviation of this baseline, then we have to kind of make allowances that we're going to hit, at least at specific points. There's going to be some technical, we're going to hit at one of these, not the between points, but one of these kind of major points, right? Typically, I think it's going to be, you're kind of looking at this range from like here to here. And then the rest of this stuff is kind of fluff, right? It's sort of just try to get you back to the baseline, okay, here and here. But it's very possible that the things, and that could look like this, where we're trying to get back to sort of the baseline, all right? And that's very possible. So, as we go forward, I hope that you guys start using this tool, knowing like these sections are coming up, and then use that short interest publication date because I think those are key markers for specific spots that they're almost always aligned with with our algorithm in specific spots. Okay, that's the way I'm looking at it right now. Obviously, as more things come about from this, people are going to dig into it more. We'll hopefully see a clearer picture of what's going on. But in terms of when squeeze, how do we short squeeze? I kind of just laid it out. Like, I think that's the roadmap. And I think it's going to happen on a technical breakout, an increase in volatility. That's it. Like, that's really what we need. And then it's going to coordinate around these dates. So these dates right here, this is November 24th, December 9th, December 27th. Now, if they get their way, they're going to try to keep it flat as possible. We're still going to see this, I think. We're still going to see this fractal pattern play out, but it'll just look really boring and flat. But just keep in mind that what we're looking for are those technical breaks, and we want to see that technical break above the wedge here and get that sign of strength if you're Wyckoff people. So maybe you can use Wyckoff with this too and just sort of see how this might play into things like the last point of support and the SOS. Because I bet you it would line up, if you play around with it. So I'm going to do really short daily updates on where I think we are in within a given cycle period, and base that on just sort of what I'm seeing develop technically. So if we're going to be in the wedge right now, that we're in the blue wedge, that's fine. Good for us. I'm okay with us being wherever it needs us to be. I just want to me, I want to see this thing move. And I don't think that, I think that knowing what we know now, we have a pretty good indicator or a pretty good indication of an idea of like where this thing might take off, when it might take off. There are these specific dates. We want to see certain things happen between those dates if you want the stock to move. Okay. So that being said, I know this was even longer than my last one. I apologize, but I really think this is kind of the meat of it. If you wanted to know like the application and what I think that going forward we're going to look for, that's it. And I know that it just boiled down to like a technical breakout, and I know that's super simple, but it's more complicated than that, right? The fractal pattern has specific places where technical breakouts tend to be the most likely, right? The beginning of the head and shoulders, the R1 dates, after the wedges. And where do those line up with those short interest dates? That's the key. So that being said, hope you all enjoyed the video. I'm going to, again, try to post daily updates on what I think is going on, where we are, and where we might be going. So, yeah, have a good one.